was like that last time.
Hello.
We're live.
How's everybody doing?
You don't have to answer us. It's good. We'll walk you through. We got another webinar today. So it's focused on small business and how to pay yourself in 2021. So the focus here is on paying dividends versus wages or salary, what the difference is, kind of explaining the pros, cons of each, and walking you through what it looks like in action. So we'll go through a brief little introduction. Who is True North Accounting? I see a lot of you guys here watching this or subscribed to it or registered to it are already clients of ours. So you probably know Matt and I already, but we're Matt and Curtis, partners at True North Accounting. And this, another monthly installment of our webinar to try and make life easy. See a lovely picture of Matt and I coming up that we always have in here, but which one is it today? There's Matt and myself at the Bridgeland office, obviously during summertime. But we'll dive into the agenda. We think this is going to be a pretty big one. There's always a lot of questions on this because it's a big topic. I'm sure I've chatted with a bunch of you about this exact thing already, but it's good. There's probably a lot of useful information you'll get out of here. So Matt can cover the agenda.
Yeah, so if you haven't attended one of these webinars before, we'll just rip through these slides for the first half of it. First 35 minutes, it's a bit of a longer presentation here, but then lots of time at the end for questions. And submit your questions through the question app along the bottom of the screen. And then you can also vote on questions that you also want to hear. So that's how we'll prioritize which questions, the ones with the most votes. So take a look through them. And if your question isn't already there, then add it and we will make sure we get to it. We haven't yet had to leave any questions unanswered, I don't think, in all the webinars we've done. So don't be scared, ask away. So in the agenda, we're going to go through why is this an important decision for small business owners? Dividends, wages, payroll. We'll explain what dividends are, salary is interchangeable, at least for us, with wages or bonus. It's all kind of that T4 income that is a business deduction. We'll go through what it means anyways. And then we'll go through like the mechanics. Like if you're doing dividends, what do you have to look out for? What are the advantages? There's a few extra things you have to do. Payroll obviously comes with its own administration. You got to do payroll remittances and T4 slips and all that. So we'll explain all those differences and then we'll get to questions. So as a small business owner, how should you pay yourself?
It's a big decision, and you can see Matt's painted us a pretty picture here, a lovely illustration. But don't let that distract you. How wonderful that is there. So it's a huge decision every year, and it's something that you can change. But it's also one of the most important. You can change year to year, but it's also one of the most important decisions that you have to make. You have full control over it, and you can totally depict the outcome that's going to happen. So the corporation's cash, it doesn't actually belong to you. Even though you own the company, that corporation owns that cash. And whenever you take it out or use it personally, it's a taxable benefit. And so that has to be accounted for as either a dividend or a salary, a wage. And so it is one of the biggest tax planning opportunities. There's multiple times throughout the year as well that you can reach out and talk about it and discuss when should I switch, should I up my wage, should I draw a larger dividend here, should I keep it even throughout the year, should I take out less, take out more. There's so many different facets to kind of look at. So number one, understanding the differences, what it means between not only dividends, wages, but the difference between personal and business expenses. So you know what you're what you're spending from the business. And then the idea that the majority of the tax that the government collects from you, it actually happens not from the company's tax rate's so low, it happens from when you pay yourself. So determining wage versus dividend there is another important factor.
Yeah, and another big piece in that decision to when you're planning around how much tax you want to pay this year, also is splitting income with your spouse. There's definitely still some flexibility there, but there's limitations. We won't get into that a lot today, but the timing, the amount, and who gets the compensation, those are the three big decisions. The flexibility you have as a business owner comes down to those three decisions, and yeah, you can save a lot of tax by thinking clearly about and knowing the consequences of each. Okay, so you like my clip art? I take it. Okay, so who is this advice for? There's some numbers in here that we're going to run, but really it all comes down to the shareholders that own a service-based corporation operating in Alberta, and it's really like that business of one, or like that small business under a few people involved. Like it's family owned or spouses, or one person owns the shares. Like one person controls it, and that's the person we're targeting with this explanation. So it's very small corporations where you're the owner, you're the shareholder, and you're in the service industry. But we won't get into like multiple corporate structures, holdcos, trusts, where like associated and like related corporate rules come into play. We won't get into
lovely complex stuff. We don't have enough time to dive into that. So
yeah, and we try not to overcomplicate these issues for our clients.
Okay, so we'll talk about dividends first. So what are dividends? Dividends are simply you as the shareholder, the owner of the business, taking out the profit. They're just extractions of cash from the business, where not that you just draw money whenever you please at regular intervals, however you want to do it. Dividends, one of the major differences, they're not a tax deduction for the business. They're simply a distribution of profit. So because they're not a tax deduction for the business, the company is going to have much higher net income normally. So the corporation is going to pay some of that tax. 10% is the small business rate currently. So whatever's left in the net profit of the company is going to get taxed at 10%. And then what you pull out in the form of dividends, tally that up over the course of the year, and you're going to pay your personal tax based on that dividend. Could be upwards of 40%, but depending on the different tax brackets that you end up, how much you take out, where you fall come personal tax time, that's going to sort of determine where you're sitting. So the corporation you tally up the draws throughout the year. You've got your total. That's what I've taken out over the whole course of the year. Put that on a T5 slip. We're usually creating the T5, but that's how your income gets reported, on the form of a T5 slip, to show the total that you've declared in dividends and that you're going to pay tax on at come personal tax time.
And if anybody's seen one of those T5 slips, like there's a dividend gross up, which is confusing. We won't get into that in too much detail, but that dividend gross up is something that's on those slips, and we'll talk about how that plays in to account for the tax that your company already paid. That it just accounts for that 10% small business tax that your corporation has already paid. But again, it's complex. So salary, when you take a salary, you're paying yourself as an employee of your own business. So you can some people take annual salary, like at the last day of the year, I'm going to bonus myself $100,000. Other people get on payroll where they're getting paid every 2 weeks, and it's kind of more like a set and forget it. Like you're getting paid as if you actually do just have a job and you're not self-employed. So those are two options. But no matter which way you choose, it's a deduction. Your wage or your salary is a deduction to the business. So the business won't pay tax on what you take out. So you then personally pay a little bit more tax at the end of the day. But again, you have your company pay that for you. So you also have to pay CPP, and if you're not like the owner of the company, EI, or if, yeah, like when you own the company and you're controlling it and you're paying yourself, you are exempt from EI. And the idea there just being, if you lay yourself off and go collect EI, but then you continue to have business income, it just doesn't really work. Yeah, and then similarly to having a job, you get a T4 slip at the end of the year, which just shows your gross salary, how much was withheld and paid in income tax and CPP. And yeah, we can do that, or payroll software does that for you. So here's some of the tax brackets, just to kind of illustrate salary compared to dividends. You can see that all the way down, dividends are taxed lower. And a lot of people just look at this chart and be like, oh, it's cheaper to pay dividends because, oh, if I made 95 grand, I'm in the 22% tax bracket if I did dividends, but 30.5 if I did salary. So there's just a couple of points I want to make here, that the dividends are taxed lower because the company already paid 10% on those dividends, or on the taxable income to the company. So that's kind of the difference there. And you'll notice the gap isn't quite 10%, but there's this concept of integration in our tax system that we do have a good slide and an example on later. The other point I wanted to make on this slide is, if you make $98,000, because you breached that 97,069 bracket, it doesn't mean you're all of a sudden going to be charged 36% on all your wages or 28.5. It's like everybody pays 25% on that first 48. Then everybody would pay 30.5% on that next 50 grand. So you only pay, like if you made 98,000 even, you would pay 36%, but only on the $931 that you were over that second tax bracket.
Yeah. New rate only applies to what's over that bracket. So I'll touch on some pros and cons here, and some of the bigger things. There are more minute ones that if we're having a one-on-one meeting discussion and we're looking at your example or your situation specifically, it can there's other things that can come into play. But here's some of the bigger ones as far as pros and cons of dividends, and then we'll get to wages. So pros, there's going to be more cash in your pocket because you're taking gross dollars straight from the business into your pocket. You're not making remittances. You're not withholding CPP. You're just taking the dollars right away. Continuing down the pro side, it's simple reporting, right? You, like I said previously, you add up what you've taken out through the course of the year, put that on a T5 slip, get that T5 slip filed, and you're done. There's much less administrative to it. It's great for corporate structures that can allow for tax-free payments between corporations. We said we weren't going to dive into this too much, but when there are if you had two companies or a holdco and an opco, sometimes dividends can flow down that structure tax-free until it ultimately comes out to you as the individual. And then finally, you're in control of the cash for longer. You're not sending the government checks. You're not cutting government, making remittances online to the CRA. You're not out of pocket that from January, February, all the way on through. You have the cash in your pocket and you're going to pay tax on it later. Cons, you're going to have to save some of that because nobody's withholding tax, right? You're going to have a tax bill personally and in the company when you're upon filing. So you need to have planned for it and been strict enough to set that aside so you have the cash to pay it. you're likely going to have to make installment payments for both corporate and personal tax. We'll talk about installments a little bit more, but for anybody that's had a big tax bill, CRA usually will follow that up saying, hey, now you got to start paying us installments towards next year. And you have to plan, save, and invest for your retirement or the unexpected, like unemployment. Nobody's contributing to CPP. EI is not necessarily there for you to fall back on if the unfortunate were to happen. So you have to plan for that. And then another big one that often comes into play: dividends aren't considered earned income, and CRA has certain types of income they consider earned income. Dividends is not one of them. And so earned income is needed for collecting CPP or contributing to CPP, increasing your RSP contribution room, and as some of the COVID relief programs we've seen now have been much more heavily favored as far as wages compared to dividends. Some people paying dividends are slipped through the cracks of the programs there. So
yeah, you'll notice like in the first few months of COVID, everything had, you needed to have a payroll account as at March 16th, or you had to show at least 5,000 in wages or dividends in 2019. And it's just a clear preference from our federal government towards wages versus dividends. Do you want to take this one too, Curtis?
Yeah, paying yourself a salary. So pros and cons again here. Pros of paying yourself a salary as opposed to a wage here. So pros: you're investing for your retirement by, number one, you're contributing to CPP. So it's going to be there for you when you retire. You're going to have, depending on the CPP is a whole nother discussion we'll touch on a little later as well, but and you're having earned income, your RSP contribution is going up. So there's a couple different vehicles to help save for retirement. CPP alone is sort of a forgotten retirement savings plan that isn't there if you only paid yourself dividends from day one going forward. So the second pro I kind of touched, I mixed those two together. So it's earned income. It increases your RSP contribution limit, which for a lot of people is a really good choice, or one of the only ones they know of as far as setting money aside in terms of having that RSP come back to you when you're retired through. And the contribution to the RSP itself is a deduction against your income, so you can save tax year to year just by contributing. You're going to be eligible for CPP, eligible for EI. If you're an owner, you're exempt, but you can opt in and still pay towards it in case something unfortunate happens with the business, and you can collect on it. So there's a different circumstance there. And then you're getting your business and your business's dollars to pay the taxes for you. So if you're contributing, you're making your remittances on your wage every month. End of the year comes, you got your T4. Hey, maybe your company has over contributed for you or made a little too high of remittances. You might even get a tax refund. Now, cons, monthly, so administrative, I guess, in more or less. The monthly remittances are an extra thing to do. It can be simplified, but it is an extra step, an extra part of the routine to build in. And there's penalties for missing deadlines or doing it incorrectly. There's less money in your pocket today. Right now, you pay yourself the net, not the gross. So you don't have as much today when you pay yourself because you're sending the remittance and the tax to the government throughout the year. You're still going to need to invest for retirement. So a wage doesn't just solve retirement problems for you. It just goes to helping them, I guess. And then there's more paperwork. It's a little more complex. So there's payroll calculations, payroll audits, deadlines. I think I already saw a question pop up asking about, is there a way to simplify this? And so there's more to understand. So it is a con. It's a lot. There's a little more to do compared to dividends for sure.
Yeah. Okay. So in summary, dividends, they really seem easier, but you still have to take that action to save a percent of each draw you make for taxes, and you do have to make those installments. So if your installments are 4 on the personal side, 4 on the corporate tax side, and then paying your personal taxes, corporate taxes, like on the deadline, if you made more this year than last year. So you're looking at like 9 payments, 10 payments, 8 to 10 payments a year. Whereas with salary, you're making your monthly payroll remittances, so there's 12, plus you might have corporate tax payments to make as well. So there's more payments, but you can automate that. On the dividend side, they seem cheaper. You get more money in your pocket, but it's the CPP that makes salary or wages more expensive, which it's argued is CPP. Actually, it's not really arguable. CPP is not a tax. It is a pension plan contribution. So if you take that off, you actually pay less actual tax if you do salary, and we'll go through an example here in a bit. People that paid dividends their whole career, I've sat across the desk from a number of people that hit a life milestone like 50, and they've just been paying themselves dividends their entire careers, and stock market crashes, oil and gas is down, real estate's not doing so hot, and they're like, wow, I haven't worked with an investment advisor, I haven't been doing RRSPs, I haven't even been paying my tax installments, so they have tax debt, they're not going to be collecting any CPP, they haven't been saving 10% of what they make for retirement each year, and it's just a scary spot to be in. The window is ticking down, and so the earlier you can start thinking about how are you saving for retirement, are you putting a percentage aside each month, the better off you'll be. And CPP just it's not the whole thing. You can't rely just on CPP, but it is a piece that wages just forces you to make that investment. And RRSPs are another thing. Like if you've done dividends your whole career, you won't have any RRSP contribution room. And it reduces your taxes even more now. You do pay tax on it later, but yeah, those are really, and then there's the CPP employment benefits that the government provides. Like, actually, we'll talk about all those later. But COVID, we have seen a bit of a bias towards wages from Ottawa. Yeah, and then with salary, there's just ways to have your business pay your taxes, and you get your net amount, and you might even get a refund at the end of the year. So going back to CPP, it is like these are just some of the additional benefits. So we do have clients that do take like a $5,000 T4 slip, like a $5,000 wage, and then do dividends, because that at least gives you some access to death benefit. There's some child benefits in there in certain circumstances, survivor's pension, disability benefits, post-retirement benefit. Post-retirement benefit is like the main CPP paycheck you get once you're 61. But yeah, it is. People might not think it's going to be around when people like millennials or Gen Z come around to retire, just because the baby boomer is such a big percentage of our population, and they're all moving into that retirement age. They're going to be collecting on it, and it's basically the responsibility of the working generation to fund that so it doesn't get depleted. Trudeau's made a lot of moves in the last 5 years to help support that CPP fund. Like 10 years ago, it was in a much worse position than it is now. And really, that's just like different tax policy, making it more attractive to do wages so that more people are paying into CPP to help fund this whole percentage of the population that's starting to collect. And the way they're doing that is they're increasing the limit, like up to $58,000 a year you pay CPP. at 10%. So they're both increasing that 58,000 each year, and they're increasing the percentage from like 10% to 10.5 and then to 11. And that's, we're I think in year 1 or 2 of that CPP restructuring right now. So up until 2025 or 2027, it's going to keep going up and up. So it is going to get more expensive, but the benefit when you retire is also, the idea is it goes up as well.
Installments. Some of you might have, they're confused. Even if you've seen them or have had to do them, they can be confusing because it's CRA forcing, essentially installments it's CRA forcing you to pay next year's tax based on an estimate of last year's tax in most scenarios. So choosing dividends, installments comes up more often than choosing salary, because if you can see personal tax installments and corporate tax installments. If you owe more than $3,000 in personal or corporate, CRA is going to request installments towards the following year, the year we're like in, essentially. Now, choosing dividends, because it's not a write-off to the company, so you have a bigger tax bill to the company, and nobody's withholding tax off your wage, so you end up owing come personal tax time. You are putting yourself in a position where you're going to be owing $3,000 or more in personal and corporate tax. That's when CRA wants installments, and they're going to say, okay, well, last year you owed $10,000 in the company, so you've got to divide that in 4, and you've got 4 $2,500 installments that I want you to make towards next year's tax, and they'll charge you interest on these installments if you don't make them. So they kind of force you to prepay towards next year. There's a few like it gets confusing in that if you don't owe what they estimated for you, you don't owe interest on the missed ones, but you can't, like, so it gets, we've got a really good help center article on our website that explains it with examples, but it is something to keep in mind if you are looking at dividends, thinking of changing, or you're already in the dividend kind of routine. Installments is one thing that it's the administrative part of making these installments throughout the year is very similar to how easy the actual remittances for wages to remit your income tax throughout can be. So it's just something to know they exist. It's a way you can flush a few bucks down the toilet by paying the CRA interest on these installment payments that you choose not to make.
Okay. Yeah, and I guess one further point there, like making monthly payroll remittances, if you miss like they're all due on the 15th of each month, you miss that, you get hit with a 10% penalty each month. But if you miss your installments, you just ignore them, you're gonna start racking up interest as well. So you have to pay attention to those dates, no matter which way you choose. Like there is payments to make throughout the year, no matter which way you choose. Okay, so Canada's tax system, like many other countries, is based on this idea of tax integration, which means that no matter which way you earn money, at the end of the day, when it's in the individual's hands and you're free to spend it on vacation, invest in retirement, do whatever, pay your cell phone bill, that's at the end of the day, no matter which way you earn that income, it's about the same. Like the government takes about the same cut. So here's 3 different methods. The first one is you have a corporation, it earns profit, $111. You pay 10% tax on that, and then you dividend. So the net after-tax cash you have in your corporation is $100,000. The second example is you own the corporation, you pay yourself $100,000 salary. And the third is you're a sole proprietor and you earn $100,000 net income. The middle one, the employee, like it also works the same as if you had a job. The only difference would be like the EI component. So number 2, it's very similar to like, yeah, you're just an employee of your own company, but it also works if you're an employee for another company. So in this example, we'll go to number 1. So the corporation you have pays 10% tax, has 100 grand left in the company, pays that 100 grand as a dividend to its shareholder, and the tax the shareholder would then pay is $16,579, and that's 2020 tax rates. So that seems cheaper, right? But then you add the $11,111 that the company already paid, and because you're the only owner of the corporation, that's money out of your pocket as well. So you add those two together, and your total tax bill is $27,690. Let's move to the next example where still your corporation, there's profit of 100 grand, you pay 100 grand as put it on a T4 slip, the tax or the total tax bill owing including CPP is $27,900, which that's very similar to the dividend. Like $27,690, dividends are a bit cheaper. But yeah, if you consider that $5,796 of that $27,900 is going towards your pension, and it's not an actual tax, it's not being spent right away on whatever, you'll get that back. The tax portion that you're paying is only $22,104. Similarly, if you earned 100 grand net income as a sole proprietor, you'd owe $28,087. Included in that is $5,796 of CPP, and so your net tax owing is $22,292. Very much in line with the employee. And then if you look at the total out of pocket for each scenario on this slide, so dividends $27,690, employee of a corporation $27,900, so a little bit more expensive, sole proprietor $28,087. So cash out of your pocket, very similar. Dividends gives you the most in your pocket, but if you just look at the tax component in the bottom section, dividends $27,690, employee or sole proprietor both $5,700 cheaper. So I think that makes a big difference. It's like you're saving $5,700 each year, just by virtue of paying into that CPP.
And it is, just to kind of clarify a little, it's just an isolated example without really any other variables. So if you think of your own personal tax situation, how many variables you have, whether it's, I got this investment income I put into my RSPs, I've got childcare costs and there's a bunch of little things that can sway these, but when you break it down, you can see how the government has tweaked the tax rates to the point where they want to accomplish tax integration. And I tell people all the time, if there was one dividends or wage that was an absolute clear winner, everybody would go that route. But it's just to kind of show an example of how close they actually fall out at the end of the day when you look at total out of pocket, at least.
Yeah, like if you looked at these numbers 10 years ago, I think dividends would have been probably more around that, like 24,000-ish. Like there was a much bigger advantage to dividends. And the other thing that's not accounted for in this is RRSPs. So if you are on if you do take a wage or a salary and then you do RRSPs, you just reduce that 22,000 even more, by about a third of what you invest. Okay, so if you choose to do the route of salary or wages and you want to get on the monthly payroll remittances, this is a very, choosing a payroll software is a very easy way to do it. WagePoint in particular has a neat feature where you can set up monthly recurring payroll. So you can set it up like, okay, I want to take 100 grand as a wage or as a salary this year, and you just basically set up like how much to remit each month, how much to pay yourself, and it will direct deposit your net amount in your bank account, send the rest to the government, and it's very much like a set it and forget it system that handles all the. It'll have your T4 slip ready to go, and companies like these payroll companies have done a lot of good things during COVID and helping people file their wage subsidies and CERB, like getting your ROE. So that's an added benefit. There's like more of the old school payroll companies like Ceridian. Actually, Ceridian's still pretty good. They've adapted, and so is ADP. They've just been around for a long time. Whereas WagePoint, Hume, Payment Evolution, and QuickBooks Online, they're the online versions. They're new. They're sleek, good user experience, access from anywhere. Did you want to say something there, Curtis?
I was gonna say we got a bunch of questions and we're already over the limit we set for ourselves, so we should move a little quicker through these last couple.
Okay. So payroll software does come with fees every month. Like you have to pay $20 to $30.
Makes your life easy though, so it is worth it.
Yeah. The other option is you can just set up recurring payments, like your payroll remittance. We can calculate. Okay, you're gonna have to have 20. Say you want 30 grand in payroll remittances by the end of the year. Well, that's $2,500 a month, and you just tell your bank to send $2,500 a month on like the 12th of each month, so that it's sure to be in there for the 15th. And then you can also set up recurring payments from your company to your own personal bank account. And then we just add up all the amounts at the end of the year, file a T4 slip, and it's pretty set it and forget it. But it does take the help of an accountant to make sure your numbers are right.
Run the calculations, split it evenly over 12 months, if that makes sense, cash flow wise, and you can set it all up to be automated, and you've got your net, your gross, and your remittance amount to the government every month, and payroll made simple.
Perfect. And this is a beautiful infographic that our team at Hawk Design helped us put together. So just like the break in the river, dividends, all the benefits along the top, wages, everything along the bottom. Maybe I'll just let it sit on that while we answer questions. But it disappeared. Okay. There we go. Okay. So we need some voting, but we'll start with the first one that has one vote. Isn't there software? Isn't there software that can just run the numbers, and advise?
I get it.
Gotcha.
Yeah.
And advise you options to maximize a given parameter based on specific needs and situation. You want to take that?
Yeah, there is tax software that can, but it's still like your own unique situation can change things. So like something as simple as making an RSP contribution versus not. So it's expensive. It's expensive software. It's not something that most people will go out and just use to run estimates. So there is software that can make it easy and can not so much advise at the same time, using the software to see, like, inputting the numbers in the software or in any kind of like tax estimate program, and then understanding what the output is telling you, go hand in hand. So it's I wish it would make our jobs a lot easier if there was just one that would spit out the advice, but
and those calculators always seem to take more tax than you actually need to pay. Like, it makes your remittances higher than, like, when we run a mock tax return for you using actual tax software, like the difference in what we would recommend you remit each month to break even, and the difference that some of these calculators or software, like the CRA calculator, for example, just tends to, like, the government wants your money in their hands, and then if you don't owe it, then they'll refund it, assuming you have all your taxes filed and you're not delinquent on any one of your corporate filings. And then yeah, they'll give it back to you. But it's kind of like give us a little bit more each month, and then we'll hold it hostage for the rest of your tax returns to get filed. Okay. What are the tax issues around the $40,000 CEBA loan for 2020?
I was just touching on this. We've seen a few already where the forgiveness amount, the 25% up to, they've changed it now so you can get total of 60, an additional 20, with 33% now being forgivable if the remaining 66% is repaid by the end of 2022. It's taxed as revenue. It looks like it's going to be taxed as revenue. It's going to be forgiven, and then when it's forgiven, it will flow through into revenue for the company. But having 10,000 out of the 40 or 20 out of the 60 potentially forgiven dollar for dollar, and just paying 10% tax on that, 10% tax on 20 grand, you're only paying an extra $2,000. And if it's been a slow year, maybe you've got other expenses, it doesn't even end up hitting the bottom line if the year is pretty ugly, as far as we all kind of view 2020 to be. But yeah, it does look like they're gonna tax it as normal income.
Okay, if I go full dividends, I will have no CPP contributions. Will my payout of CPP at 65.70 drop due to not contributing anymore? And yeah, Alan, thanks for that question. I saw your email today with this question exactly. No, you've contributed over your career, 30 plus years, and so they're not going to take what you contributed away, but you do need 39 years of contributions to like max out your CPP. But yeah, it won't go down. Anything to add on that one, Curtis?
You can contact Service Canada, Google their number. You can call in. You can get them to run they have all your info. Answer some verification questions. You can get them to run the numbers and tell you what your CPP payment would be today. And so it's set in stone right now, and it only like if you contribute more, it could potentially go up, but it's not going to decrease by stopping contributions to CPP. I'm not sure what their online portal, how good that is. We're not too we're with talking to CRA on CRA's site, but Service Canada is a whole nother side. So it's something you can do. You can go ask them tomorrow when they open up. You can call them, wait on hold. It'll be horrendous, but you'll eventually get through, and you can have them tell you. So.
Okay, good. Next one. Is it easier for you to make tax planning recommendations if you do both personal and corporate taxes for us? Definitely. Yeah. When we know your personal tax brackets of you and your spouse, and if you and your spouse are both shareholders of different classes, then we have the flexibility based on both of your incomes. Is it better how much dividend to pay to each of you, or how much wage, how active are you in the business? So yeah, it definitely gives us the full picture. This is where like accountants are in a pretty unique situation, because we have that actual financial data on your business and your personal side as well. So yeah, it's definitely an advantage.
And not only looking at the tax planning, tax splitting potentially, there's other more subtle things to, like, either maybe you're paying yourself a dividend, and there's unique little things in the tax system that if you have childcare, you can't claim childcare expenses against dividend income. It can only go against employment income. So if we didn't see your personal side or vice versa, we might not know certain things like that, and we just couldn't advise. We wouldn't have the full picture, so we couldn't really advise properly as good as we otherwise could. So yeah, it definitely makes it easier.
Okay. Which cost me more, salary versus dividends from an accountant cost perspective? That's a good question. Yeah, I guess like in our pricing, I guess we build a little bit more into T4 slips like if you're on a payroll software, it's easy. Like basically there's no cost if you use one of those payroll softwares. On the dividends, we do just have to count up the draws, but it's pretty simple to do a T5 slip. It's where you're wanting to do dividends and you haven't made any remittances, and we have to figure out how much you took throughout the year. That's just a little bit more work. But I don't think we really charge that much more. Like if we charge 120 for a T5 slip, we might charge 135 for a T4. So
yeah,
minimum.
from the cost that you're going to pay an accountant is going to be much less than the like knowledge and tax savings you're going to get from making the right decision. So it's such a minor variable in the equation of accountant costs that yeah.
Okay. I have no need to draw down funds from one of my corporate entities. How long can I keep the funds in that corporation before CRA begins to question the use of proceeds? Currently invest the funds in the company under the company name in equities bonds, so I can indefinitely keep it active to show income, thus draw it in the future when in a lower tax bracket. This is a great question, Christopher, and this is where having a corporation can act very, like it can almost mimic an RRSP account. If you leave the money in the corporation, you can invest it. You get a tax savings now because you're only going to pay that 10% tax. And then when you do withdraw it, like it can grow, those investments can grow as you work. And then when you do retire and you're not making an income, you can start cashing in some of those investments and drawing a dividend each year. Where
forever you could
Yeah.
you don't CRA, they can ask questions, but your corporation's its own entity. It can own whatever it wants to own. It can invest whatever it wants to invest in. It can keep that even beyond your death. Like a corporation will continue to live, and it can keep those funds forever and ever and ever.
The big milestone would be when your corporation switches from active, like an active business, to passive, like inactive. And when that happens, you just want to make sure your mix of investments is right, because like another new rule in the past few years is that passive income over like 50 grand a year is taxed extremely high. It's punitive. Like, so the government doesn't want you having 2, 3, 4 million bucks in investments, all earning 5%. You would, like, it's not smart tax planning. But up to 50 grand in passive income, so interest, real estate rental income, dividends, like you just want to invest in the right stocks. So growth stocks, for example, if you're approaching that 50 grand in income. So that'd be the milestone to watch out for.
Yeah, and just to finish that off and touch on, Michael, your comment that it is investment income in a corporation is taxed high, but there's the benefits or the refund portion, the savings comes back to, you see it when you eventually flow that money out to an individual by dividend. So the government wants you, they tax it high in the hopes that they want you to eventually get it out to your own personal hands.
Yep. So if I have no, I'm going to start. Okay, if I have no revenue for the year, do I need to fill out and file a tax return? What happens if I don't? Are you talking corporate or personal? I guess either way, there's benefit. Like personal, for example, you file a tax, you're gonna get a refund. Like there's the GST credit, there's the climate incentive credit, there's what else is there?
Yeah, there could be a few other, some non-refundable, but there are some refundable tax credits depending on how big you are. So With personal, definitely, but both, and Kevin, you said corporate, like regardless of the type, even in the corporate scenario, no income, the CRA in their system, they're always going to see that the 19 or the 2020 return is outstanding, and they're going to be expecting it, and eventually they're going to come and ask, why haven't you filed? We need you to file. Are you closed down? Do you have income? Can you? And they eventually they come around and start asking questions. So you do, there eventually they may force you to file or continuously bug you until they get the answer they need, because what they're
Yeah.
seeing is an unfiled return. Hey, maybe there's income I can go tax. And there's what's called, oh, it's gonna slip my mind, the arbitrary assessment, where CRA will estimate your income for you. And so you don't file for long enough, and they're going to say, well, we think you had 100,000 of income because you did a couple years ago, so you owe us tax on that and GST, and pay us. And if you don't file to prove them wrong, then they think you owe it, and they follow the same steps as if you did owe it. So or notional assessment, arbitrary assessment, they refer to it a couple different ways, but it's
Yeah,
important.
if you showed 100 grand in 2018 and had no income in 2019, but you didn't file, they'll get a letter saying, oh, we think you owe us 25 grand for 2019. And if you continue to ignore it, that's when you get into the next letter you'll get a year later is, no, we've garnished your bank accounts. And like, just that if they don't have the information, they're just going to start making stuff up. So if you have no income, you can file a nil return, which is quite simple. You just put zeros all the way down, but you actually have to have no activity in the company.
Yeah.
Okay, that one's fine. Since I started my company 10 years ago as a corporation, I started working 25 years prior as an employee. Would I still get the CPP based on what I previously contributed?
Yep. Since you're 18, you are eligible to contribute to CPP on earned income, on employment income. So your first couple jobs had CPP, and usually it starts out slow and increases as your pay increases after you 18, you grow. So if you've stopped at one point, it's all set in their system. They have history, they have records of all the CPP you've ever contributed. And if you stopped when you started your corporation and started paying dividends, for example, and stopped contributing to CPP, what you did in the prior 15 or prior 25, whatever the case may be, that's still locked in, and your CPP when you retire will be based on that calculation, unless you start contributing again to add to it.
Yeah, and I think you can just call Service Canada, maybe have your last year's tax return on hand, and they should be able to give you an idea of what you can expect to earn once you start collecting. And so you can build that into your retirement planning. Okay, we'll go to the one with 2 votes. Do you find people will split paying themselves salary and dividends to maximize the least amount of tax to pay? So Hayden, what we find, like the thing that makes wages expensive is CPP. And once you breach that like 58 grand a year, you stop having to contribute to CPP. So if you're at like 100 grand in total compensation, should you take 58 in wages and then the rest in dividends? Like anything over 58 grand, that's when wages become cheaper. And I haven't seen a situation, unless you're talking about like $400,000 or $500,000. Yeah, I haven't seen a situation where splitting it like that equates to less tax owing.
Yeah, in a very simplified scenario, splitting them is usually inefficient. One or the other is usually the way to go. And like Matt said, especially if you're doing a wage and you've already went over the max CPP at like 58,000, it's more efficient to continue with wage instead of split. But there can be other reasons too, depending on the corporate structure. Maybe triggering a dividend will have a refund in the company for investment income, or there's other unique circumstances to every individual that's like, well, normally it doesn't make sense, but for you, because of this one reason, we like, so you got to kind of analyze your own scenario the same, but or analyze your own specifically so you can really see what makes sense for you. But yeah, splitting doesn't usually make the most tax efficient sense, but sometimes it can be done for other like cash flow reasons, or for there can be other reasons to do it. It's just usually if you're doing a wage, sticking with the wage is the way to go.
Yeah, so that's something we do for most of our clients around this time of year. Like, okay, how much were your total draws during the year? Oh, they were 100 grand. Okay, this is what you'll owe if you took it all as dividends. This is what you'd owe if you took it all as wages. And here's a split 50-50. And you can just like see actual numbers. Like, okay, this is the decision I have to make. Okay, this is a little bit more expensive, but these are the benefits. So we give our clients actual numbers based on their, like, we'll start their own tax return based on like their family situation and all that. So yeah, it's an important analysis to do. And yeah, just make sure you've done it so you know you're making the right decision.
And Chad's kind of goes on the same path there. Kind of, if you've already been paying yourself a wage, say you set yourself a salary, something. Oh, we got an edit. Top up. Is there a benefit to pay yourself with payroll, then top up with dividends when needed? So splitting. So I guess hearing the last question. So splitting isn't efficient. What do you suggest if we want to pay extra wages to ourselves on a given month? So you can. Some people, you can view it the same way that, hey, we're going to top up with dividend, but you're just topping up sort of with a bonus, right? You're adding on to the wage. And a couple different ways to do it. You could, those months where you're like, hey, I've got extra cash in the company that I want out, or I need extra cash personally, so I got to get more out. You could run a separate payroll calculation so you know how much more to do your remittance for, and that way you kind of top up your base pay that you've given yourself. Another way that if I see people doing it, and CRA is they're fine with this if you're the owner operator, like if you're the owner of the business, you're paying yourself a wage, you can continue your remittances as you've been doing the whole time, and just that net top up is just an extra net wage. And so essentially at the end of the year, your T4 is going to have more taxable wages, and you're going to owe more tax than you actually remitted because you never increased your remittances. So
Yeah.
you file your tax return personally, you've got this T4 and you've under remitted to yourself. So you're going to owe more tax come personal tax filing time.
Yeah, like say it's a 10 grand like top up or like bonus you want to pay yourself. You just pay it and then you pay that extra tax when you file by April 30th. But where this like top up idea, or that, I guess that it works well when you have two business partners that aren't in the same household or aren't related. So two shareholders that have agreed that, okay, we're each going to take a salary of 100 grand, and then if there's profit left in the company at the end of the year, we can pay ourselves a dividend, which ultimately a dividend is a distribution of profit. So it's like a profit split. So in that scenario, when you have an arm's length business partner, it could make sense because not everybody's, their own tax situations might be very different, and it might just make sense to add that dividend on top of the salary. So yeah, but if you control it all yourself, you can just do a bonus instead of the dividend. Okay, last question. Curtis, you want to take this one? If my corporation is based in Alberta, but I want to work remotely in other provinces, does my corporation have to pay taxes in other provinces?
So not necessarily. You can still be an Alberta-based business, pay provincial tax, like pay tax as if you're in Alberta. CRA has some rules on where you're going to claim that you're filing as a corporation. And one of them is if you do have employees and you're paying employees for working in another province, then there can be calculations that have to be done that'll be 40% of my revenue and 30% of my wages were paid out in Ontario. So you kind of get a ratio of you sort of calculate out a percentage where it works. Maybe it's 35% gets applied to the provincial rate for Ontario versus the remaining 65% gets hit at the Alberta rate. But if it's just you, if you don't have like a business presence, that's the wording CRA uses. If you don't have a shop or a sign hung up, if you're just out working, you're still an Alberta corporation getting taxed in Alberta. It doesn't, as long as you don't have like, CRA will even say like, do you have a sales guy? Do you have like a place of business there? If you don't have a business presence in another province, you're still taxed as if you were in Alberta the whole time.
Yeah, you're ultimately taxed where your address is, where your corporation lived on the last day of the year. But this is an interesting question when, like, it doesn't apply so much in Canada, but like in New York City, people are going nuts right now because so many people have been commuting from Jersey, Connecticut, all these different, or a few different states around New York, but working in Manhattan. And now they're all working remote from Jersey or Connecticut. And it's just a disaster trying to figure out, like, New York City still trying, or New York State still trying to tax them, but so is their home state. And COVID has really thrown a huge wrench into this whole situation. So it'll be interesting to see. Like, I can't think of, like, maybe Ottawa, like, you could be in Quebec or Ontario. But yeah, out here, it's like if you work in BC in the oil patch or Saskatchewan, it's more clear cut. But yeah, that is all the questions, and we're 1 minute over. So thank you everybody for joining us. Hopefully there was some value there, and don't hesitate to reach out, make a meeting, have a call, and have a Merry Christmas. Happy New Year. Everybody's excited for 2021, I think.
Yeah.
And so we will send this out tomorrow as a recording. We'll just email it out to everybody. And yeah, if there's something you want to go back and watch again, you can do that there.
Or if you have questions that weren't answered, or you just have a more complex scenario, reach out to us and our team, and we'll tackle them separately.
Perfect. Okay. Thanks, everyone.